Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor. Any new monetary regime is bound to have a profound effect on your wealth and investments as a whole. But of course, talk is cheap. So what we really want to do, rather than trust the views of any one person, is to listen to the language of the markets, which provides a superior wisdom that comes from the collective wisdom of millions of market participants. To help us decipher the language of the markets, I am really pleased to have back with me right now Michael Oliver. Through his firm, Momentum Structural Analysis, Michael has for over 20 years provided proprietary technical analysis to asset management institutions. And to learn more about Momentum Structural Analysis in its history, you need to go to Oliver's. That's www.olivermsa.com. Mike is the author of the book, The New Libertarianism, Anarcho-Capitalism, which was just reviewed by the Mises Institute, and they describe the book as, quote, much more than an academic thesis, but a distinguished addition to libertarian thought, end of quote. Well, it's really good to have Michael with me. Welcome, Michael. It's good to have you back.
Good to be here, Jay.
On May 29th, you wrote a very important piece for your subscribers titled Four Connected Tectonic Plates. Those important plates are the S&P 500, gold, the European stock market in general, and then the euro and U.S. dollar exchange rate. So I'd like to ask you to talk about those for a bit. Tell us why those are so important, and starting perhaps with the S&P 500.
Well, it's not always the case that all markets are linked, but in this day and age when the central banks have made more or less the 800-pound gorilla in the markets, they do tend to link things up, either inversely or coincidentally. And these four markets tend to have a good correlation to one another, not day to day or week to week, but when you stand back and look at their monthly, month-to-month swings and so forth. In particular, I can see it in the momentum readings of these four markets. S&P, of course, up. Gold is now down. That relationship had been coincidental up through mid-2011 when the central banks were doing their QEs and commodity assets were actually rising more than stocks. But that broke down decisively in mid-2011. Gold peaked in August, September of 2011. Most commodities also peaked then. And they divorced themselves from stocks, and now gold is clearly, in my momentum work anyway, technically opposite stocks, wave by wave, almost month by month. Therefore, we have S&P in a bull trend, a very old one. We now have gold in a downtrend, at least about 3 years old now. And they're both at about the same juncture point, where it looks to me like gold could be either one has made its bottom, that would be the dual lows at 1180, which occurred last year, or it has one more spike to go. In other words, blow those lows out, generate a highly likely spike bottom that does not sustain on the downside, and then flip back up. I'm open to the prospect that it goes either way, but I do think gold is either bottomed or is close to a bottom time-wise. And as far as price goes, I think a low would probably be in the low 1100s, so not dramatically below the 1180 low, should we decide to go that way. Mm-hmm. S&P is doing essentially the same thing in reverse. It has continued to make new erosional highs this year. Each month it'll tickle out the high of the prior month and then fall back and then go a little bit more. But on its momentum charts, it's identical to gold, but upside-down version of it. It looks like the S&P is either about to peter out in terms of its annual momentum and therefore put in the top. At the same time, gold is trying to develop its bottom. So those two are inverse. Now, obviously, the European stocks, and I look at the DAX index primarily, which is equivalent to the S&P 500 of Europe. It is the stalwart index of Europe. But I also look at the Euro Stoxx 50 index, which is 50% of the European stock market capitalization. And I've run numbers on it, and it is obviously correlated positively to the S&P. It's not as strong as the S&P by any measure, but it is in the same directional movement. It has numbers that are about 2% below its current price. That if seen at the end of this month, on a monthly closing basis, the way I measure it, it's turned down. The S&P's numbers, just to make a note if you want to, it's now in the 1920s. If you get down to 1863, the end of this month, and the number will be adjusted sharply up next month, that is a monthly close that indicates to me a top is in place. That's about 3% below the market. So we're talking about numbers that aren't far away, so a sneeze by these two equity markets will, in my view, with my work, indicate top in place. Now we go to the 4X markets and the euro and the dollar index. You got to remember that the dollar index, which is one of the ways most traders measure the dollar, is a basket of exchange-weighted currencies. The euro is about 57% of the dollar index. So what the yen does, what the British pound does, the Swiss franc really don't matter too much. It's what the euro does in terms of causing the dollar index to go up or down. The euro has been positively, very much so, correlated to the S&P and to the developed stock market indexes for the last several years. The euro just made a recent new high, not a new high all time, but for the last few years. At the same time, within days of when the S&P made its size. The euro right now is in the 136 area, and frankly, if you close out this month at 135.60, which is just barely below recent lows, that indicates to me top in place in the euro. And if you go back and study its long-term momentum, if that occurs, is a good likelihood that the S&P will be one monthly bar away from doing the same. So what I see are these four different market arenas, each which can be measured on its own, but they all link so well, either inversely or coincidentally, that they're a package. And therefore, I think if you were on a desert island and you had some of my work in front of you and you had only monthly closing data to operate on, you would be able to know when the S&P is topped, when the dollar is turning up. Now, I know this is an effrontery to a lot of gold bulls who think that the dollar must be down for gold to go up. That is a mistaken notion, in my opinion. Gold is an anti-fiat currency, a money. It's against all fiat currencies, not just the dollar. The dollar is now matched by other equally liquefied currencies like the euro and the yen. So if the dollar goes up, it doesn't indicate necessarily any great fundamental strength in the U.S. or in the integrity of the currency. It just means it's better than the others.
Yeah.
It's a relative statement, and people need to realize that.
Sure.
So I see a dollar potential up as being negative to S&P. The European stocks and U.S. stocks are linked, and gold is inverse. So these four all together, my suspicion is they'll all turn, whenever they turn, within a month or so of each other. And they'll give, in effect, a chorus of asset direction change of a long-term nature. And
okay.
It looks to me like we're near that point.
Okay, Michael, and that leads me to my question. We just have a couple of minutes left, but
okay.
Why do you think this, in other words, your chart, your most recent piece shows sideways action, essentially a sideways top for the S&P, and it shows a sort of a sideways bottom or a base for gold. Why do you think this, and it's gone on for about a year, why do you think it can't go on much longer?
Well, the gold market, if you look at annual momentum, let's just take gold as the inverse of the S&P. If I plunge out the price lows, I go to other time scales of my measurement, which I use quarterly momentum and monthly, not just the annual. And they clearly tell me that if I punch out those lows in gold, it is probably an exhaustion spike because none of the other momentum indicators will confirm a new low in gold. The gold would have to go off the page to achieve a confirmed weak low. In other words, one that is validated by weak momentum readings. Instead, now, if I blow out those lows, if I do, and I'm not at all sure that's going to happen, I think you get about 2 weeks for gold and the S&P to power up on the S&P up into the 1950s, and for gold to get down around that 1200 mark, which is the low 50-point reading on the gold bear so far. And right now we're in the 1240s and quietly steady. I'm open to the possibility we don't ventilate the gold lows, and we don't ventilate the S&P on the upside. Instead, they both wither effectively for the next week or two, just short of levels that would indicate some more, and you get a quiet top, as opposed to a violent, exciting one, a dramatic low in gold, for example. Instead, you just simply make a higher low here in the 1240s, okay. and
all right,
it's possible.
Well, but I mean, So just to summarize here, because we're just about out of time,
okay.
If I understand you properly, what you're saying is it's highly likely we're going to see a turn downward in U.S. equities and in European equities. It's highly likely we're going to see an uptick or a turn upward in the U.S. dollar relative to the euro. And it's highly likely that we're going to see a turn up in gold after a possible another plunge down, but a brief plunge down, and that these markets are so interrelated that when one goes, the rest are likely to turn as well.
I think they'll all pretty much go as a chorus, and I think that will tend to validate whatever you see in one. If you see it in the other, and the other, and the other, it's a chorus, and it's a true statement.
Well,
you can act on the information.
It's an excellent summary that I'm very privileged to have seen. I want to thank you very much, Michael, for coming on the show. And again, for our listeners, it's olivermsa.com. For more information, and Michael does provide a service to institutional clients primarily and wealthy individuals. So it's not a retail service. But Michael, very happy that you could come on and explain this stuff to us. I know those of us on this show are looking very, very carefully at gold because we have a lot invested in gold in one way or gold shares or gold stocks, and we don't have time to ask you today about gold shares, but we might like to have you come back on sometime in the near future to discuss that as well.
Be happy to. Good.
Thank you very much.